Welcome back. This is lesson 1 of FOREX Made Easy, a basic Forex video guide by Eazitrade Academy. And in this video, we'll be covering the topic, what is Forex?
The general conception is that Forex trading started in Amsterdam roughly 500 years ago. Beginning in Amsterdam, Forex trading then spread further throughout the world. The present-day Iraq, known as the Mesopotamia tribe, introduced the first method of exchange known as the barter system in 6000 BC. Most of us will be familiar with the barter system, an exchange system whereby you give what you have to receive what you need, more like you are trading an item for another item. So this very system of exchange lasted a very long time, but at a time the need for a better means of exchange arose. That was when spices and salts became another means of exchange. So if you want to get something else that another person has, you have to trade the salt. You have to trade some salt rather, or spices for that. After that, we got to a period whereby the gold system was introduced. People traded what they have for gold. The gold system lasted a while, and the need for something better came up. That was how you got to paper money. And today we have the Forex market. Internationally, you can trade from wherever you are, trade the currencies of other countries, pair your own currency against the currencies of other people in different countries. Say for instance, you have cedis and you moved down to UK. You want to exchange cedis for British pounds in order for you to be able to use the money locally. So when you exchange cedis for British pounds, you have participated in the Forex market. You have participated in the Forex market automatically. Okay, so that takes us to what Forex actually is. Now, what is Forex? Forex is simply the exchange of international currencies which are traded against one another in pairs. Remember, in pairs. You don't trade a single currency, you trade currencies in pairs. So by the time you pair one currency against another currency, you are either buying the other currency and selling your own currency, and the other person is buying your own currency and selling his own currency to you. Now, the word Forex is a combination of two words, foreign and exchange. You take away FOR from foreign, combine it with EX from exchange, and you get Forex. It's therefore accurate to say that Forex is foreign exchange. Simply put, it is also sometimes called FX. So whenever you hear FX, you should just know that they're talking about foreign exchange. They're talking about Forex. The Forex market is otherwise known as the biggest market in the world. It has a market capitalization of over $5 trillion. So you'll be wondering what you have been doing all this while, chasing money elsewhere, whereby you have the biggest market in the world in Forex.
With this, we have come to the end of this lesson. I do hope you understood all the concepts taught here. You might want to rewatch this video again just so you have better understanding. And if you have any questions, please feel free to ask on our support group. Our coaches are ever ready to answer all your questions. Alright, see you in the next video where we'll be looking at currency pairs. Bye for now. Welcome back. This is lesson 2 of Forex Made Easy, a basic Forex video guide by Eazitrade Academy. So in the previous video, we covered the topic, what is Forex? And in this video, we'll be covering the topic, currency pairs. Alright, so before we get into currency pairs, let's take a look at the major currencies in the Forex market. I know this is something that a lot of us want to know, which currencies are the kings of the Forex market. Okay, so we have the United States dollar, of course, the dollar has to be there. So we have the United States dollar, we have the euro, we have the Japanese yen, we have the Great Britain pounds, we have the Swiss franc, we have the Canadian dollar, the Australian dollar, and the New Zealand dollar. I know many people do not know that there are other countries that also use dollar. You think dollar is just dollar, but no. We also have other countries that use dollar apart from the United States, okay? So these currencies are referred to as majors because they are the most traded currencies in the Forex market, okay? So they are the most traded currencies in the Forex market, all right? And these currencies, their symbols, how they are written, is always in 3 letters. Okay, so the first 2 letters usually represents the name of the country, and then the last letter represents the name of the currency. For example, now the United States dollar is written as USD, all right, which stands for United States, US, and then dollar. Okay, and then the Japanese yen is written as JPY, so JP for Japan and then Y for yen. So this is how our currency symbols are written, but this doesn't apply to all currencies though. Okay, as you can see in the euro, okay, so it doesn't apply to every single currency, but it applies for a lot of them. Okay, so what is a currency pair? So I'm going to be looking at what a currency pair is right now. So a currency pair is a price quote of the exchange rates for 2 different currencies traded in the Forex market. I'll take that again. A currency pair is a price quote of the exchange rate for 2 different currencies traded in the Forex market. So now let's break it down. In every currency pair, there are 2 currencies, of course, not that a pair is 2. So for every currency pair, there are 2 currencies. The first currency in that pair is the base currency, all right, while the second currency in the pair is the quote currency. Right, so let's look at an example to help us understand it better. So here in this pair, you can see here, the euro is the base currency, while the USD is the quote currency. Okay, so I hope that is clear. Now the rate tells us how much of the quote currency we will get when we exchange with 1 unit of the base currency. So in this case now, in this currency pair that we have, this simply tells us that if we give 1 euro, we'll get $1.19. Okay, so let's see another example. In this pair here with Great Britain and Japanese yen, what this is telling us that if we give 1 Great Britain pound, we get 137 Japanese yen. Okay, so with 1 Great Britain pound, you get 137 Japanese yen. So I hope that's clear with the rates. Okay, so there are 3 types of currency pairs. Right, so we have the major currency pairs, we have the minor currency pairs, and we have the exotic currency pairs. Now let's look at what these all mean. Okay, so the major currency pairs all include the US dollar on one side and then another major currency on the other side. So the major currency pairs have US dollar and another major currency making up the pair. So these pairs are the most widely traded pairs in the Forex market. Major currency pairs are the most widely traded pairs, okay, because of the US dollar. And then the minor currency pairs are also known as cross currency pairs. Please take note, minor currency pairs, we also call them cross currency pairs. They do not include the US dollar, but they can contain any other 2 major currencies. Okay, so minor currency pairs don't have the US dollar but have any of the other major currencies. For example, we could have Euro Great Britain pounds, we could have Australian dollar paired with Swiss franc, we would have Great Britain pounds paired with Japanese yen. So these are minor currency pairs. Okay, And then finally, we have the exotic currency pairs. All right. So the exotic currency pairs, they have one major currency and then the currency of an emerging economy. Okay. They have one major currency and then the currency of an emerging economy. For example, we can have the US dollar paired with the Singapore dollar. We could have the US dollar paired with the South African rand. We could have the Great Britain pounds paired with the Indian rupee. Okay, so exotic pairs have one major currency and then the currency of an emerging economy. So I hope this is all clear. With this, we have come to the end of this lesson. I do hope you understood all the concepts taught here. You might want to rewatch this video again just so you have better understanding. And if you have any questions, please feel free to ask on our support group. Our coaches are ever ready to answer all your questions. Alright. We'll see you in the next video where we'll be looking at PEEP and PEEP value. Bye for now. Welcome back. This is lesson 3 of FOREX Made Easy, a basic Forex video guide by Eazitrade Academy. So in the previous video, we covered the topic currency pairs, and in this video, we'll be covering the topic PEEP and PEEP value.
All right. So what is a PEEP? A PEEP simply stands for percentage in points or price interest points. It's the smallest price movement or move that a given exchange rate can make based on market convention. Typically, currency pairs are quoted to 4 decimal places. All right. And a 1 PEEP movement would be the last decimal place. Why for just JPY pairs, it's 2 decimal places. So stay with me as I explain further. So in this particular image, PEEP was well broken down, as we can see. Now, just to take us back a little while we're in school, remember we did units, tens, 100,000, millions. So a PEEP in Forex is just simply a units movement. So let's look at this image while I break it down. So in Forex, a PEEP height is simply lesser than a PEEP, as we can see. So from this calculation, we have 2 here. That was why we see 0.2 PEEP height. And the next is 1, and we have 1 PEEP. The next is 7, we have 70 pips. The next is 2, we have 200 pips. The next is 1, we have 1,000 pips. The next is the other one, the first one before the decimal place is 1, and we have 10,000. So if, for instance, everything, the number changes, it's the same calculation. If the one with lemon green, which at the extreme right, changes to 1, it will be 0.1. If it changes to 3, 4, name it, or 9, it will be 0.9. Same for this particular one, the green. If it changes to 2, it will be 2 PEEP, 3, and also the count goes, if it's ascending or decreasing, it's still a PEEP movement. Why for the dark green, which is 7, it's simply in tens of pips. So we have, if it changes to 5, it will be 50 pips. If it changes to 4, it will be 40 pips, and so on and so forth, which is the third place after the decimal point. Why the second one is in what? Hundreds of pips. So if it changes ascending or descending, it will be calculated 100 pips, 200 pips, 300 pips, and so on and so forth. Why the one after the decimal place is thousands of pips. It goes 1,000 pips, 2,000 pips, 3,000 pips, name it. Then the one before the PEEP, all right, that one is calculated in 10,000s of pips. So basically, major pairs has 6 numbers. Then after the decimal place, it is 5 numbers, 1, 2, 3, 4, 5. then why a pip, again I repeat, is calculated on the fourth number after the decimal point. All right, so let's move further. On the next slide, we are seeing how a major pair looks like. As you can see, this is an image of Euro USD. The one in the green background is the base currency, while the other one is the quote currency, which will be further explained in our subsequent videos. All right, so as we can see, there was a change from 1498, and the next on the quote currency it was changed to 1499, which is simply a pip movement. So if, for instance, this particular base currency, which has a green background, was initially 1.1497, if it increases to 1.1498, that's a pip movement. So if it increases for 1.1499, as you've seen, it's what? 2 pip movements. That's 2 pip. It's as simple as ABC. All right, I hope this is well understood. And let's move on to the next slide. Now this next slide explains to us major pair movements as seen. The one that is red, the figure that is red, is the pip movement, while for JPY pairs, the figure that is red, which is 5, is also the pip movements. Okay, so on the last slide, Euro USD is trading at 1.1940, meaning that with €1 you can buy 1.1940 USD. If the rate changes to 1.1935, which is a decrease, it means that there is a difference of 1.1940 minus 1.1935, which will give us 0.0005, which is a 5 pips decrease. So if there was an increase, it would be 1.1945.
With this, we have come to the end of this lesson. I do hope you understood all the concepts taught here. You might want to rewatch this video again just so you have better understanding. And if you have any questions, please feel free to ask on our support group. Our coaches are ever ready to answer all your questions. All right. See you in the next video where we'll be looking at lot sizes and leverage. Bye for now. Welcome back. This is lesson 4 of Forex Made Easy, a basic Forex video guide by Eazitrade Academy. So in the previous video, we covered the topic pip and pip value. And in this video, we'll be covering the topic lot sizes and leverage.
To start with, what is a lot size? In Forex trading, a lot refers to the standardized unit of measurement for trade size. So let's take a look at the breakdown explanation. 1, we have a standard lot, which in figure it's a whole number, and it represents 100,000 units of the base currency. If you are familiar with your quotes, a base currency is always at the left, while the quote currency is always at the right. So for example, if you are trading Euro USD, one standard lot will be 100,000 euros. Let's move on to number 2, which is a mini lot. A mini lot in figure is 0.1. This is 1/10 of a standard lot, or 10,000 units of the base currency. So if you are trading a mini lot of Euro USD, you are trading 10,000 euros. Third, micro lot, which is mostly used by beginners in Forex because of what? The minimal risk it has. This is 1/10 of mini lots, or 1,000 units of the base currency. Trading a micro lot of Euro USD means you are trading 1,000 euros. Now, the last on the list, which is not commonly used, is called nano lots. This is 1/10 of a micro lot, or 100 units of the base currency. Trading a nano lot of Euro USD involves 100 euros. These lot sizes allow traders to control the amount of currency they trade and manage risk more effectively. Smaller lots, mini, micro, nano, are particularly useful for beginners or those with smaller trading accounts. Like I said earlier, smaller trading accounts are often amounts that are lesser than $500, even $1,000. That's the truth. But let's peg it at $500. So if your account size is less than $500, make do with micro and mini. If it's $200 below, make do with micro and open minimum 2 positions if you are trading a major pair. If you are trading instruments like gold with very high volatility and you're not yet very, very familiar with the market, you've not understood the market to an extent, maintain a single position. I just gave us a what? Risk management guide. So let's move on to looking at the pictorial diagram of lot sizes. As seen here, I made mention of their lots, how it's calculated in numbers. Standard lot is a whole number, that's 1. A mini lot, being 1/10 of a standard lot, is 0.1 or 0.10. Then a micro lot is 1/10 of a mini lot, 0.01, and nano, which is not commonly used, is 1/10 of a micro lot, which is 0.001. So we can see the amounts that they trade. If you are trading a major pair, you can see the total units of each lot on this diagram. So let's take a look at this other diagram, which also showcases the pip if peradventure you are trading a major pair, all right, which are Euro USD, GBP USD, USD JPY, USD CAD, and so on and so forth. If you are trading a standard lot, as seen here on this diagram, you will be making $10 per pip for a standard lot. If you are trading with mini and you enter with 0.1, you'll be making $1 per pip. While for a macro, you'll be making $0.1 per pip. And for nano, it will be $0.01 per pip. So moving forward, let's look at a broader explanation on this diagram. Let's read. Standard lot, which is one lot, 100,000 units of a currency. A standard lot represents $10, a point when using Euro USD as a base currency, while a mini lot represents $1, a point when using Euro USD as a base currency, and micro lots represents $0.01 a point when using Euro USD as a base currency. The point they are talking about is the pip mentioned in the previous diagram. I hope this is well understood. Now, the next on the lesson that we're about to talk about is leverage. And just so we know, we can't talk about leverage without talking about the following, starting from equity, margin, free margin, margin levels. So let's proceed. On the list, we have equity. If you're familiar with your trading interface on MT5 or MT4, I am sure that it might have been a question that has popped up if you've not done a research yet, or if you've not done your findings. Equity in Forex trading simply represents the total value of a trader's account. It is calculated by adding the current profit or loss of all open positions to the account balance. So, in a mathematical form, it is said equity equals to account balance plus unrealized profit or loss. So, for example, if your account balance is $1,000 and you have an open position that is currently $200 in profit, your equity would be $1,200. If, for instance, the market goes against you and you are on $200 loss, all you have to do is say $1,000 minus 200. That will be 800. That means your equity at the time, your unrealized, your balance rather, plus unrealized loss is $800. So that's what equity stands for. The next is margin. Margin is the amount of money required to open a position. It is a portion of your account's equity set aside and allocated as a deposit for your trade. The required margin depends on the size of your position and the leveraged use. So let's look at the example. For example, if you want to trade one standard lot, which is 100,000 units, right, of Euro USD, and the leverage is 1:100. Now note, leverage for brokers differs, it varies, and once we go into leverage, you will get to understand how it's being used and the risk involved. So I continue. The required margin would be 1% of the position size. The required margin. So as calculated in mathematical form, it is required margin equals to position size over leverage. So if your capital is 100,000, all right, a 1:100 would give you the opportunity to leverage on 100,000. So if you are entering the market with a standard lot, which is 1, that simply means you are leveraging on that 100,000 to trade with $1,000. So for every 1 pip, you will make $10. While for every 10 pip, you will make $100. Now note, Note, you are trading with what? $1,000. That is the amount. But if you don't have the kind of amount, don't attempt to use a standard lot to trade. And before you can even attempt using a standard lot to trade, you must have gotten a broader knowledge about the markets to an extent, and possibly you must have good mentorship before you can attempt. I'm saying this for the sake of risk management. All right, so let's move further. The third is free margin. Free margin is the amount of equity in a trading account that is not tied up in current positions. It is available rather to open new positions or to withstand potential losses. Let's go further. Free margin equal equity minus used margin. For example, if your equity is $1,200 and the margin required for your open position is $1,000, your free margin would be $200. So that means as at the time you took that trade, you have a free margin left of $200 that will not be affected by the market. So for the sake of risk management, ensure that your stop loss is within that $1,000 that you used in entering the market. This is where a lot of traders makes mistake. They will leave their stop loss open. Thereby, if the trade goes against them, it will start affecting the free margin. If you've ever been liquidated, there's a part in the markets that once your free margin begins to show sign of being affected, it will go from blue to red. That is caused by poor risk management. In further videos, we will see practical example of that, or in subsequent videos. The last one is margin level. Margin level is the ratio of equity to used margin expressed as a percentage. It helps traders understand the health of their trading account and how much of their equity is being used to maintain their open position. This is calculated as margin level equal equity over used margin times 100, which is the leverage we talked about earlier. That's 1:100. For example, if your equity is $1,200 and your used margin is $1,000, your margin level would be 120%. So we can see free margin. The balance was what? Or the balance is $12. And while in the trade, what I am trading with at the moment is what? $5. That is what I'm risking. Entering with just this particular lot size, which is a micro lot, and I have a free margin of $7, which is not in the market. So we can read up on this repeatedly, looking at the practical implications of high margin level and low margin level and the risk involved, so that we can be able to apply proper risk management. Okay, so we're going to be looking at the actual topic, which is leverage. And like I said earlier, you can't talk about leverage without talking about margins, because it will not all go well when you finally want to know how to use leverage and you don't understand margin equity, free margin, margin levels, which we've dealt with in our previous lessons. Leverage in Forex is a way for traders to borrow capital to gain a larger exposure to the FX markets or Forex markets. With a limited amount of capital, they can control a larger trade size. This could lead to bigger profits and losses as they are based on the full value of the position. Leverage, which is the use of borrowed money to invest, is very common in Forex trading. By borrowing money from a broker, investors can trade larger positions in a currency. However, leverage is a double-edged sword, meaning it can also magnify losses, just like I explained earlier. So you must be in the level of a professional before you can start using higher leverage. So oftentimes, brokers have a default leverage for proper risk management. It is advised that you don't alter the leverage if you are not yet a professional trader. Leverage in Forex trading allows you to control a larger position with a smaller amount of money. For example, with 100:1 leverage, you can trade $100,000 with just $1,000 of your own money. This amplifies your profits but also your losses. If the market moves in your favor, you make more money, but if it moves against you, you can lose a lot more than your initial investment. It's essential to use leverage carefully and manage your risk properly. Please underline that last statement, very important. Now let's look at the pictorial explanation, the pictorial diagram of leverage. This is it, your deposit. With a leverage, you have higher buying power, as explained initially. So you can deposit $100, and if you use your leverage, you will be taking advantage of $10,000 in the markets. All right, so that will be that for leverage.
With this, we have come to the end of this lesson. I do hope you understood all the concepts taught here. You might want to rewatch this video again just so you have better understanding. And if you have any questions, please feel free to ask on our support group. Our coaches are ever ready to answer all your questions. Alright. We'll see you in the next video where we'll be looking at risk management and position. Bye for now. Welcome back. This is lesson 5 of Forex Made Easy, a basic Forex video guide by Eazitrade Academy. So in the previous video, we covered the topic lot sizes and leverage. And in this video, we'll be covering the topic risk management and position.
So on our first topic, we'll be looking at position sizing. So what is position sizing? Position sizing is simply determining your lot size. If you don't understand lot sizes yet, kindly refer to lesson 4 and watch how lot size was explained over and over again. So for position sizing, calculate the appropriate lot size based on the size of your trading account and the percentage of your accounts you are willing to risk per trade. So let's see a pictorial diagram. So as you can see on this image, the leverage, required margin percentage, required margin amount for each of the lot sizes were explained here. We have nano, which is not commonly used. We have micro, we have mini, and we have standard. So the leverage is based, the leverage and the account sizes are all explained in a tabular form. As we can see, for leverage 200:1, what is required is a 0.5% of what? Your capital. So if you're having $100 capital for a nano lot size, it is required for you to risk 0.5%, which will be $0.50 or 0.50 cents. Alright, then if you are trading with $1,000, it is required for you to risk what? 0.5%, which will be $5. So if you are trading with $10,000, you risk what? $50. $100,000, you risk what? $500. Alright, so that means if you are trading with $100 rather to, let's say, $500, you can still maintain 0.5%. Alright, you already have how would I put it? You have a range that you can trade with. It's not necessary. For instance, now if you have a $30, you're trading with a $30, you can still use the range of $50. So if $100 you are required to trade with 0.5%, just know that anything less than $100 you can either make do with 0.3%. Then anything within $100 to $200 or $500 you can make do with 0.5%. But I believe this is well understood looking at this pictorial diagram. So let's move forward to the next on our list, which is setting of stop loss orders. So how does this work? It is important to apply appropriate stop loss or to apply stop loss when trading. It's part of risk management, a core part of risk management. So I'll be using MT5 to show us an ongoing trade. Since this is weekend, hope we know that if you are trading forex pairs, which are the likes of XAU, gold, Euro USD, GBP USD, USD CAD, and so on and so forth, you are to trade on calls from Monday to Fridays, while cryptocurrency pairs is always available 24/7 every day. So that's why you can see that BTC is still running actively. Alright, so let me put on my data so we can see. I have to put it up so I don't get interrupted. So we can see that BTC is ongoing. Once the network comes, you can see the movement of BTC, while the other pairs, codes, are static. As you can see, forex pairs are static, or currency pairs rather, we can tag it as currency pairs, and crypto pairs are moving. On my list, I just have BTC. Alright, so as you can see, once I open this trade, let me open a new order. Alright, so it is very important that you always have a trade plan. Very key, and stop loss and take profit should be a key part of your trade plan. Fixed stop loss. Place stop loss orders to automatically close trades at a predetermined loss level. So if you are to go long, as if you are to buy this trade, so let's buy at current price. Alright, so I'm using a 0.2. Okay, I have an existing trade which is no longer moving since currency pairs ends on Fridays. Alright, so as we can see on this BTC USD trade, all I have to do to modify this is to long press and click on modify position. Looking at the current price, which is around 64,344, I can bring, that means I have to bring down my stop loss to, let's say, 63,800. If I want to take profit, I can do 65,000. So with this, excuse me, it's 3,800. So with this, I am good to go. But eventually the trade goes against me, my loss will be minimal. All right, my loss will be minimal. So if the trade goes against me, my loss will be minimal. I'll be losing, instead of losing my total capital, if this was a live trade, all right, if this was a live, instead of losing my total capital, I will lose minimal amount of my capital. All right, now there's what we call trailing stop loss. Trailing stop loss is not often used by most brokers, so it's something you can do manually. So trailing stop loss helps you to lock in profit as the market moves in your favor. So it's something you can actually set manually. Let me explain. On this ongoing trade, if for instance the market goes in my direction, let's say I'm now seeing blue, all right, all I have to do is adjust my stop loss. All right, let's say the market moves to 64,800 and I'm seeing blue. I can decide to adjust my stop loss to my current entry price, maybe, or put it at 64, yes, to my current entry price. But eventually the trade goes against me, I'll be exiting the market I'll be exiting with little or no loss. So my entry price initially was what? This is my entry price, 64,378, as stated here. That's my entry price. So if the market goes in my favor, all I have to do is adjust my stop loss to 64. As if the market is above my entry price, I can adjust my stop loss to 64,500. But it will not show modify because the modify is not highlighted because the market is yet to move in my favor. But once modify is highlighted, you will see once the market moves in my favor and is above my entry price, you will see that modify will be highlighted for me to modify my stop loss. So that is that for trailing stop loss. So with these few things I've said, we can now see how important it is to set our stop loss. Take profit. If you are someone who knows how to who monitors your trade, you can leave your take profit open. But if you are doing other things, set your take profit so once it hits, you are out of the market with profit. All right, so that said, the next on our subtopic is diversification. Diversification is simply what is to avoid overexposure. Don't put all your capital into a single currency pairs. Spread your investments across different pairs and markets. All right, but note that this is for people with sufficient capital. So for instance, if you are trading with, let's say, $500 or $200, let me peg it at $200. Instead of you trading just BTC and opening more than one position, you can trade BTC, Euro USD, and if your plan is to open 3 positions, you can trade 3 different pairs provided you understand the market movement of those pairs, instead of just trading, opening 4 positions for a single pair. Because if the particular pair goes against you, that means you've been losing in all of those positions. All right, so as you can see on this list, so it's well explained that I already have an ongoing trade which ended on Friday and it's going to continue on Monday. So it is actually a common sense to trade a different pair. Since I'm already in profit for this, I cannot just decide to now still trade USD JPY pair. I can decide to trade gold, I can decide to trade other pairs. So that's what they meant by diversification. Don't overexpose yourself, because you will be increasing your risk. All right, so moving forward, the next on our list is leverage use. We can refer to lesson 4 to have a better understanding of leverage if we've not actually allowed it to sink in. All right, so leverage, talking about leverage use. When we talk about leverage, most brokers, like the one Eazitrade uses, which is XNEX, make do with 1:2,000, which is approximately 1:2 or 1:20 or 1:200. It all depends. All right, so when you talk about leverage, use leverage cautiously. Higher leverage can amplify both gains and losses. It's safer to use lower leverage ratios, especially for beginners. That is why you can see on XNEX there is a default leverage that should not be altered. So the only time you can alter it is probably when you want to trade with a higher amount. You can as well chart up their support. You can as well chart up their support to give you an advice on the leverage to be used. Or you can still maintain the default leverage for proper risk management. It's only on the occasion when you know you have full confidence, you're now a master of your trading skill. That is when it is advisable for you to move or go higher or use a higher leverage, so you can be able to magnify your profit. You can increase your profit for every time you enter the market, knowing fully well that you are also at risk of losing more should a trade go against you. So in other words, your trading plan is key before entering the market. All right, so the next is, I also have a pictorial explanation on leverage. As we can see here, we have leverage that can be used on different amounts, on different margin, on different, name it, trading amounts. So the lesser the leverage, the lesser the risk. The higher the leverage, the higher the risk. Take note. Now the next on our list is the risk reward ratio. That's the next on our list, the risk reward ratio. On the risk reward ratio, ensure to set what they call targets. Aim for a favorable risk reward ratio, such as 1:2 or 1:3. This means risking 1 unit of currency to gain 2 or 3 units, which has been explained in this particular diagram. Okay, so if you are trading with $100, ensure that you are risking, and your leverage is, for instance, we are using 200:1. We're using 200:1. You can decide to risk just 0.5% or 1%, all right, or 1% of your trading capital All right. So if your trading capital is 100, do your maths. 1% of 100 would give you the amount to be used. So 1% of 100, if the leverage is 100:1, 1% will be what? Of $100 will simply be $1. So that is what you are risking to enter the market. All right. And your lot size for a $1 should be between, let me show us the next diagram slide. As we can see here, account size and lot size. So if you are trading with a $100, your lot size should be between 0.01 to 0.02 for a micro lot. So it's advisable for you to maintain a 0.01 and 0.02. So trading with a higher lot when your capital is not more than $100 is what's putting your account at risk. And the higher the currency pair, the higher the volatility of the currency pairs like gold, is always best, like I would tell students, it's always best to maintain 0.01 lots. But if you are trading major currency pairs like Euro USD, GP USD, USD CAD, USD JPY, you can move higher to 0.02. This goes a long way to say that you understand how to apply proper risk management. Now the next, which is also very crucial, all right? Okay, before I move to that, let's look at how to adjust accordingly to the market movement. Be willing to adjust your target based on the market conditions and volatility. I think I've already explained that. So what are they trying to say? I've explained it already. Because you are trading with a higher volatility pair, which is gold. It's always best to know how to adjust. You don't use 100 pips when you know that the market can always change its direction. You can maintain a 30 to 50 pips on pairs like gold because of the volatility, or max 70 pips. Then when it comes to major pairs, you can maintain a 20 to max 30 pips because they are not that volatile. So it's best for you to take your profit when you can and mark good for that trade, and that will be a win trade for you rather. All right, so moving forward, we'll be looking at the next on our list, emotional control, which is very crucial in trading. And for emotional control, you have to avoid over trading. You have to avoid over trading. Don't be moved by what probably you made your first win, you made your second win, you feel like, okay, I need to trade more, this thing is going well. You might get your fingers burnt at the end of the day. Stick to your trading plan, be disciplined, and avoid risking impulsive trades based on emotion. What that simply means is you've actually made your first 2 wins for the day using a 0.01 lot. Then you now felt it is now good for you to increase your lots to probably 0.02 or 0.03. Now you are not trading based on your trading plan anymore. You are trading based on emotion because your overexcitement is what is pushing you to change your trade plan, which can also get your fingers burnt. And when you have your trading plan in place, learn to accept loss. It's called loss acceptance. Accept losses as part of trading. Don't try to immediately recover losses with risky trades. Probably your first trade you lost, the second trade you lost, using your stop loss as you should. All right, using your stop loss as you should. Now this, let me also remind us, for risk reward ratio, your take profit should always be higher than your stop loss. So for instance, once you enter a trade, if your take profit is 40 pips, let your stop loss be what? 20 pips. If your take profit is 30 pips, let your stop loss be 15 pips. That's what they mean by risk reward ratio. So your take profit must be way higher than or must be twice higher than your stop loss, or 3 times higher than your stop loss. So if, for instance, you also want to make your take profit to be 50 pips, you can make your stop loss 20 pips, because normally you ought to gain more. You ought to gain more, not losing more. You cannot set 20 pips as your take profit and be using 50 pips as your stop loss. That is not a good trade plan. That is not a good way to manage your risk when trading. All right, so that explained. The next on our list is market analysis. So you have to have a better understanding of technical analysis, how to use charts, how to understand technical indicators to make informed trading decisions. Also, for fundamental analysis, you have to keep an eye on the economic news and events that can impact currency pairs, which is part of things to know as a trader. All right, so we have regular review, we have use of trading tools, and we have education and training, which all goes hand in hand with market analysis. For education and training, you have to learn continuously. Continuous learning is very, very important. Stay updated with the latest trading strategies, risk management techniques, and market development.
With this, we have come to the end of this lesson. I do hope you understood all the concepts taught here. You might want to rewatch this video again just so you have better understanding. And if you have any questions, please feel free to ask on our support group. Our coaches are ever ready to answer all your questions. All right. We'll see you in the next video, where we'll be looking at market order types. Bye for now.